Hi, my name is Christopher Terry, and in this video, we are going to be discussing trading versus investing. When we hear about the markets, we generally gravitate to the NASDAQ or the Dow. That's a favorite one, the Dow. And the one that we actually look at is the S&P 500 for trading, and also the S&P 500 for investing. The S&P 500 is a collection of 500 of the top stocks in the stock market, and it's basically a barometer for the strength and weakness of the overall market. So when we hear people say the market was up, the market was down, generally they're talking about the S&P 500. Now the S&P 500, we're going to take a look at the chart we use for trading and also people use for investing. So let's take a look at that. Okay, this is a chart of the S&P 500. This is actually what we call the futures index or the futures contract. And I'll explain what that is in a moment. But we have January 2014 to basically January 2015. Okay, within a couple of days at the time of this video. And we could see the market over the period of time has had all these little swings up. And for investors, they would just buy. They would just buy the market. They wouldn't necessarily buy the S&P. They would buy stocks with the index, or they would buy actually a stock that represents the index, which is called the SPY, S-P-Y. And that SPY basically over a period of time. So let's just say you've invested into the SPY at $182. You spent you bought 1,000 shares. You spent $182,000. And now it went from 182,000 to 201,000. So in a year's time, you gained that difference. You gained about $18,000, but on your 182,000. So you made a 10% return on the index itself if you invested. The stocks in the index, all right, stocks in the index are stocks you've heard of Apple, Abbott. There's lots of different stocks. The stocks is Amazon and Amgen, which is a biotech, and Bed Bath & Beyond. All right, so there's thousands and thousands of stocks out there, but 500 of the top stocks are placed together in an index, and they've created that index, and it's called the S&P 500. Now we, as traders, we trade, we don't invest, meaning we look at short-term opportunities. Okay, and let me show you what that is. So we take a look at the ES, that's what they call the ES contract, and we look at it on a very short-term basis, what we call an intraday basis. So investors buy and hold. Traders are able to take a position, whether it's going to go up or down. We could determine if we feel the market is going to go up, we buy it here and we sell it high. If we feel the market's going to go down, we actually can what this called sell short. So if we make what we call a bet to the downside at 2004 and the market goes down to 1985, we actually gain roughly 20 points in our favor. Even though it went down, a trader can make a bet to the downside, a trade to the downside. Now, we can shift. We could be a buyer or we can be a seller, and we could be instantaneously in and out of the market. It's absolutely amazing. So to be a trader, you could take a long or you could take a short trade where an investor can only buy and hold. So we prefer short-term trading, or what is called short-term investing, which gives us the opportunity to get in and out of the market in a very short period of time and not have to take long-term risk. The other thing is, if you take a look at the market here. So here's something that's interesting with the markets that you don't get in investing. So the market went from 2011, and each point per contract, we'll get into that in another video, but each point is worth $50 every time it moves up or down. So, for instance, went from 2011 to 1974, and then it went up, and then it went, and then it went down, and then it went up, and then it went down, and then it went up, right? So the interesting thing about the markets in terms of trading is we have what's called a trading line. So if you count all the points that it went down, all the points that it went up, all the points that went down, all the points that went up, and up, you actually collect more points on an up and down basis than you would in a direction if the market was to start here and end here. You see, if you bought here and sold here, you only went up a little bit and you had that one opportunity. Here, you have the opportunity to buy and sell. So that's trading, or what they call short-term investing. So a trader makes bets up or down, and an investor buys and holds. Okay, and they wait it out. So you have people that maybe buy the market here, think it's going to go up, but if it went all the way down, for instance, if they spent 1,000 shares, 200,000, and it went down at 185,000, they're stuck. They have to wait for it to come all the way back up again. So there's a benefit to trading over investing where you can control your risk and your exposure, whereas an investor, their risk is the market has to go up. And that's about it for this particular video. And the next video, we're going to talk about introduction to Forex.